All right, everyone. So this time I'm going to do a video instead of writing out an email to just get some of my thoughts out and just to give you guys some information on what's going on in the market. By now, at least, you must have heard about the coronavirus. And if maybe at the beginning of the week you didn't realize the market was getting crushed, you probably know now. So let's look at what that means, how this correction relative to other corrections is playing out, and then let's take a look at best case, worst case scenario in terms of your possible portfolio and some areas that maybe you could go to if you don't want to go 100% cash, um, or so some opportunities, some places that you should stay away from, things like that. So let's just start with giving you some frame of reference. I think that would be a probably better way to start this video off. Let me just throw this into a monthly. That's better. Okay, so 2000, right, topped out. That's a 20-year bull market. So from 1980 all the way until 2000, that was a 20-year bull. From about 2000 to 2013, that was a 13-year bear market. And say from 2013 to current, we are in a bull market. Just understand that bull and bear market cycles happen all the time. They've been happening since the stock market, came to be. And one of the things that you need to understand about them is the emotional tug that they have on the market. And so in prior emails, we talked a little bit about why 2000 happened. Let's take a quick look at that bull market, okay? So I said the bull market started back in 1980, right? So the reason why we say that is because similar to the bear market that lasted from 2000 to 2013, you can make a case that between, let's call it 1965-ish to 1980, you were in your own, you were in another bear market. So 13, 14 years there. From there, you get a nice, solid 45-degree angle kind of market, right? You get away from it, you come back, you get away from it, you come back, whatever. So that's just simply trending. 45-degree trending is the best kind of trending. It means that the market is doing exactly what it should be doing, which is pricing things in correctly, okay? Once 1995 happened, you can easily see that we stopped with that whole 45-degree angle thing and we went about 75 degrees. Listen, it's a standard deviation equation, okay? You got so many standard deviations away from the mean as far as trend is concerned. And so what this did, and the time and the regulation was a lot different back then, because regulations were a lot more lax. So they were literally advertisements that were telling people to buy stocks. That isn't the case anymore. But, obviously you see there's other ways to build excitement and bring people into the market. So let's just say from 95 to the top, you went up about 239%, give or take, in about 5 years. So, one of the things you need to realize about the market is 45-degree angle is the way to be. That means that things aren't overpriced, things aren't overvalued. There isn't a lot of overweight positions as far as institutional and fund managers are concerned. It's just a steady as it goes kind of pace. When the retail investor and when fund managers put all their chips on the table, when there are no longer any buyers for stocks left, they'll only become sellers. Simple supply and demand, okay? And that's what had happened in 2000. Everybody and their mom piled into the dot-com bubble. Every single company started a website, and every single institution that can throw money at a company that started a website did, and they threw a ton of money. So it didn't matter if those companies were profitable or not. So very similar to some of the software companies and IPOs that we see today. It just happened in a different way with different technologies back then. So you pull all these people in, people that don't belong, buy, a lot more buying than selling. You get up to the top in 2000, you have no more buyers left. There is no more room to go to the upside, and you only have downside. So you get your first from 2000 to 2002, 2003, you get about a 50% correction. That same exact thing had taken place from, say, 2003 to 2007, except you had an even bigger correction, 57%. Great. So you have your 13-year bear market, and the bear market took out the 2003 low, which it did in 2009, and from there it has been on an epic journey higher. If you had bought at the low and sold at the high, 432%. Okay. Most people weren't lucky enough to buy the perfect bottom in 2009, but let's just say you started investing somewhere in 2013, 122%. See how that changed, huh? So throughout all bull markets, you get these periods of correction, consolidation, sideways movement. In 87, it was a little bit more than sideways movement, but really what you could take from 87 can really set you up to understand what's happening right now and then what's always kind of happened in the market. So let's just take a quick look at that. So let's get rid of this trend line. Okay. Let's say you somewhere over here. Okay. Just very simple. Okay. Trend line. So get away from the trend line, come back. Get away from the trend line, come back. Get away from the trend line, come back. Don't worry about the trend line. It's not like multi-billion, trillion-dollar funds and institutions and markets out there have any idea where or what these lines are. But just understand from a simple, this is the trend, are we headed in the right direction standpoint. When it gets away, when it starts racing higher, you should expect it to pull back hard. Okay. So you saw that there, and then you saw a bunch of sideways consolidation, and then stair stepping higher, right? That's how a market should work. That's what you want to see. After it stopped stair stepping higher, it raced off, and that's how 2000 happened. So let's look at current bull market. So in the current bull market, you have a lot of that same action. So from 2009, you started really racing away, and you can see, it got so oversold in 2009 that the bounce obviously would be violent. So it bounces violently, it comes back, and then it starts trending, which is exactly what everybody wants to see. Starts trending, starts to pull away from the trend, and then it goes into a sideways consolidation. Understand this. When it comes to just following trend, there's two ways to kind of get back to the trend line. It's going to happen by price or by time. And so what that means is that instead of every time it gets away, you get these sharp corrections right back to the line, you get this sideways consolidation. So back in 2014, 2015, and 2016 for that matter, you had multiple 10% corrections. Okay, so there was about a 9.5 there. You had about a 10, 11% correction there, another 13% correction. That is a healthy market. Now, as investors are concerned, that's no fun because you're seeing your money go sideways. But it's very, very healthy. So if you have a long-term time horizon for your investments, which you shouldn't even call them investments if you don't, then that is fine, right? Great. So then 2016 to 2018, and let's talk a little bit about that. So really what happened coming into 2016, you had the election, right? So you get that really fast drop. Oh my God, Trump's going to become president. Big fast drop, and then the second he becomes president, we race off higher. Understand this from just a political standpoint. It doesn't matter if it was Hillary or Trump. It wouldn't have mattered who it was. The market was going to go higher. The only thing that you really need to take from, the headlines that say, oh, this political, this president or this senator or whatever is going to make, is going to just understand that it never matters. The only thing that somebody in politics ever affects is the sectors within the market. It's rare, extremely rare, that somebody in politics can do anything with the market. It's, we're talking about like the Federal Reserve, we're talking about global economics. The United States president will never be able to sway a market. Even though Trump likes to, go on Twitter and pump the market all the time, which, from an investor standpoint is great, but he has little to no sway over the market. So, politics aside, we have a beautiful run from 2016 to 2018. Okay. And January of 2018 was the top. February of 2018, all hell broke loose. And the reason why that is, and just like you saw in 1987, we got ourselves a little too far away from the trend line. We pulled a lot of people in. And then the problem with going parabolic like that is that you don't tend to go sideways and consolidate. You tend to shake and create a ton of volatility, because what happens is they call them weak hands, meaning that the retail investor got involved, fund managers got in with the cash that they had on the sidelines too late, and then whenever you get some shakes to the market, people have, they have weak hands. They'll sell quicker than they normally would. So you pulled everybody in, you create the February 10% dip. What that did is it chased everybody into three areas: bonds, utilities, and REITs. So quickly, I will show you what that looks like. We're talking about XLU, utilities. So look at that. Utilities don't create new technologies. Utilities do not cure cancer. And these things were ripping. Absolutely ripping. You'll never see anything like that ever again, likely in your lifetime, that utilities rip like that. And you can see the aftermath of what happens when they get too far away from the trend. REITs, so XLRE. So here, kind of the same thing, right? So everybody started piling in to REITs, massive rally into, we're talking about real estate, grows with inflation plus appreciation, pays good dividends, but it started trading like it was a tech stock. And finally, bonds. Now, the correlation between bonds going higher is that yields continue to go lower. So, not to get too crazy into a bond conversation with you, but just understand that a lot of where you get your mortgage rates from, bank interest rates and things of that nature, it comes from the treasury yields. You can look at the 10-year yield, the 20-year yield, however you want to really slice it up. I am no bond expert, but just understand that we've hit a new all-time low in the 10-year treasury yield. So you'll probably be able to refinance your house at a better rate. But what that does is it basically, you can no longer go into bonds for safety and get a good yield. So where do you go if you want yield and safety? You go into utilities. So bonds, the yield goes down. Utilities that have a great yield race higher. Same thing with REITs. Okay, I want yield. Where do I go? I go into REITs. Well, if everybody is racing into REITs, this is exactly what happens. Look, it doesn't matter if you're a technology stock, a utility stock, an energy stock, it doesn't matter. If you pull too many people in if you pull too many people in too quickly, this will happen every single time. You went parabolic, and that's what happens. So let's talk about the market in terms of how deep a shit we're in. Okay, so this was probably, I think I saw that it was one of the worst weeks in the market. I think it was one of the 5 worst weeks in the market in history. So you're living through a historical moment. Congratulations. The reason why that happened, and not to be overly repetitive here, but you had yourself a 44% rally in the market from the December low. Okay? December low to the top was 44% in a year. That is a massive rally. That was a historical rally as well. So you're getting an anticipated correction of that. But because we got so far away from the trend line, from just a standard normal trend, this is the type of violent reaction you get. So where's our worst case scenario? Where's our best case scenario? Our best case scenario at this point is this. If I were to just make up some kind of consolidation, man, you really hope it doesn't get there. But let's just say something like this, okay? So let's say it kind of stays here and consolidates over time. That's your best case scenario. Your worst case scenario, that this thing continues straight down for another 8 or 9%. Why is that level significant? Without getting too technical in technical terms, the bars you see down here at the bottom are volume by time, meaning that currently I have this set to a week. So every single individual bar represents the amount of volume traded within a week. On this axis, these volume bars mean volume by price, meaning that these are the bars, this is all the traders and investors that got involved at this price. Why is that significant? Because it means that when we get down here, there is kind of a support, a foundation that has been built, buying and selling in this area. Okay, so you have a market for these prices in this area, right around 2,800 to 2,700. If that area fails, the worst case scenario is that we break our trend. So we'll break our 11-year trend. We have a long way to go before we get there. A long way to go. Right now, you can expect a bounce. And the reason why you can expect a bounce is because on every single measure you can ever imagine, every indicator, anything you can dream up, we are oversold. And oversold signals to this extreme, this is a McClellan oscillator. We have only 5 times, oh, that's right, I don't have this in the, one moment. So we're at 127 right now. The only other times it's been this low, 2011, 2010, 2009, 2001. Again, historical levels of oversold. I don't think you actually saw that, but so you have 127. This was way worse. 140, 130 something, 130 something, and probably just got past 120 here. Extremely oversold. It's a breadth indicator. Basically, what it means is just massive amounts of selling versus buying. Historical levels of selling. So, where to go from here? What sectors should you be looking at as opportunities? What sectors should you be looking at? What sectors should you be looking at to stay away from? So, one of the things I want to show you is XLK. And I'm going to show you this in a couple different ways. So, XLK is a technology ETF. And unbelievably, this had not taken out its 2001 high since This the 2000 high that it created was not taken out until 2019, 2018, and then again in 2019. So why is that significant? Because similar to the 13-year bear market that happened from 2000 to 2013, technology was in a bear market for that long. It may not have seemed like it, if you're looking at stocks like Apple and Amazon, but a sector as a whole, not just the best performers, it was in a bear market for that long. So we're technically only in a 1.5, 2 year long bull market for technology. Great. But again, race too high too quickly, went parabolic, and we're about to get reset. And the best case scenario there, if we were to just play the trend line game, okay, so you're going to come down, hopefully maybe to the 75, 80 level. Worst case scenario is you get back down to the 60 level. That's for technology. Now, utilities, look, you can go here for yield, so at least you got the yield as a benefit. But even at these prices, you're away from the trend. You're going to see this come back down to earth. One of the issues with energy, this is something that I was actually looking at because it was undervalued. And recently, if I can pull up my bookmarks here, pretty wild. The energy sector's S&P 500 weighting has fallen all the way down to 3.5%, which is less than utilities, and leaves it as the third smallest sector in the S&P by market cap. That is historically low. When it was at its low in 2016, it wasn't that low. When it was at its low in 2009, it wasn't that low. When it was at its low in 2002, it wasn't that low. This is a completely beaten down sector, completely undervalued, and completely underweight in fund manager portfolios. The reason why that's so crazy is that you have companies like ExxonMobil, like ConocoPhillips, like Phillips 66, like Schlumberger, like Halliburton, companies that make money, pay dividends every single quarter. No issues paying their bills, not a ton of debt, makes money, pays dividends, and they're getting destroyed. When you have companies like Uber, or you have companies like Lyft, or you have Blue Apron and all these other crazy companies coming out that don't make any money. Like if I were to just look at like a software name, okay? Look at this. Okay? Just racing higher. Coop. Okay? Racing higher. Software just absolutely taking off. Hasn't stopped taking off. Okay? So software has been absolutely crushing it. That's probably why the sector is where it's at right now. But most of these companies don't make any money and they don't pay any dividends. So you're seeing a sector like the energy sector just completely beaten down, but they actually make money. And they're at historical lows as far as valuation is concerned. So I would call this an opportunity if I wasn't completely people just don't want to race to value right now. They don't want to do it. You look at materials, just completely getting hammered here. I mean, a lot of stuff is getting hammered, but materials never took off with the rest of the market. Okay, you want to look at industrials. That's BIS, I believe. Industrials. Industrials had a little bit of this going on, which I'm not going to get into technical patterns with you right now, but more of a consolidation pattern than a trend. Okay, so this wasn't exactly parabolic. You could say this kind of was a little parabolic in 2017, but since 2017, sideways. So these are going sideways. XBI, biotech, same thing, going sideways, not just going parabolic. These are areas that I think in the future, if If you want to talk about outperformance, I believe these are the sectors. So biotech, industrials, materials, and energy are going to outperform technology over the next, let's call it 3 to 5 years. I think technology is always going to lead the way, especially semiconductors, over the next 10. But I think as of right now, if you need to adjust your portfolio, um, especially over right now and then kind of looking forward the next 3 to 5 years, I think you got to find yourself some undervalued things like this, things that aren't parabolic, and then that's where you kind of put your money. How are we doing? Probably pretty long, 25 minutes. We're gonna stop it there. Um, the next video I'm gonna do, I might just do another video right after this one, just so I could keep them about separate topics. Just portfolio building. I'm gonna show you guys something I put together that kind of makes things a little bit easier. You don't need, like, I have Morningstar Advisor Workstation software. You don't need to pay up for that software to create something like this and really diversify your portfolio. So I'll show you how to do that in the next video. Well, hopefully this was hopefully I kind of like drinking out of a fire hose, guys. But wanted to get a lot of thoughts out there. Wanted you guys to kind of see what I was seeing again with the S&P 500. Let's just call it the market. There is some downside to go. There is a couple of levels here that if you see them break, we will have some issues. But we're a little ways away from that right now. Like I said, I can easily see another 8% from here. Your best case scenario is that 8 or 9% gets dragged out sideways, and this isn't as violent as the last week has been. But you know, we pulled ourselves so far away from the trend that I would not be surprised that if this just came all the way back down the next 2 to 3 weeks. So, all right, hopefully it was helpful for you guys, and look forward to doing the next video for you. Thanks.